This is the Building Wealth Podcast with your host, Stephen P. Sitkowski.
Well, welcome everybody. Stephen Sitkowski here. Happy to have you for this edition of my Building Wealth podcast. On an interesting side note, at least interesting to me, we started this a couple of months ago, and last week the podcast was viewed by 183,000 people. So apparently, we're giving folks what they want. They're letting other people know. And if you like this and are getting value, I'd love it if you did the same. So it is April the 13th. The year's just clicking along, is it not? Yeah. And I got to tell you, these are interesting times. We got a whole bunch to talk about. Now, I realize some of you are in listen only mode, maybe in your cars or at your office. Others of you are watching on a computer. I do have a lot of visuals, but anything that I utilize that I think would add value to your experience, I'm going to make sure I also describe just in case you can't see it. Okay. Um, Little bit of my history. I've been working with people and their money now for over 40 years. Um, I started this at the age of 19, went out and got every license I could think of, became a certified financial planner and a registered investment advisor. I ended up running a $2 billion brokerage firm, so I've seen the investment world from the inside. And let me tell you, it's not pretty. I've been the president of two different financial planning organizations. I've had an opportunity now to train somewhere in the neighborhood of 1.5 million people. And basically, what I do is I take what I've learned independently, what I've learned from others. I have some great people in my circle and share that with you to try to make your journey just a little bit easier. And, in today's world, it is hard to get good information. It's hard to get unbiased information. So the good news is I am not tethered to anybody. I'm not tethered to any brokerage firm. I don't have any investments that I sell. So everything about this is just all geared for you. And as you know, you can watch this for free. So that ought to tell you everything that you need to know about my intent in providing this service. I want you to know that what we do here is for educational and informational purposes only. Nothing should be construed as investment advice. So even though I may talk about a stock that, I think might be particularly attractive given its current price, what have you, I'm not suggesting you run out and buy the stock. It's just something for maybe you to consider. But I don't know anything about your personal financial circumstances. I don't know how much money you do or don't have. I don't know what your risk tolerances are, what your goals are, your age, and so forth. But if I think it's worth sharing some info, I'm certainly going to do that. So, what's moving the markets? Boy, these are interesting times. If you'd have painted the current scenario to me and said, and for the year, the market's down 20%, I'd have thought, well, that makes sense with everything that's going on. But that's not what's happening. We've had a lot of volatility in the market in 2026. But the fact of the matter is, the market has been unbelievably resilient. So today, Trump announced a blockade by our Navy. Um, so we're not going to let any ships pass in and out of the Strait of Hormuz, where Iran apparently is trying to charge a toll. So we are there to stop that. It is not lost on me that before this war, ships were able to come and go, right? Now all of a sudden, it seems like we're at war so that we can get back something that we had a month ago. Now, you might point out, yeah, but We had to go in there and destroy nuclear capabilities. And, listen, it all comes down to what you believe and who you believe. You remember when we were going to go in and we invaded Iraq because they had weapons of mass destruction? I don't know, and I don't pretend to know. All that I'm saying is it seems like right now with this blockade, we are fighting and spending money for something that we had just a few short weeks ago. I guess, understanding the nature of war the best I can as an outsider and knowing and reading about the costs, then we have the loss of lives. And anyway, wouldn't you think that that would have had a monumentally detrimental effect on the financial markets? I would have. As I mentioned, markets have been very resilient despite higher oil prices. We're going to check in on the latest prices on oil. But when oil prices go up, generally speaking, stock prices come down. Higher oil prices are bad for everything. They're bad for the economy, they're bad for the individual. They are highly inflationary, which makes it much less likely for the Fed to reduce interest rates. And I will tell you that the stock market loves lower interest rates. There isn't any question about that. So it flies in the face of all of that. So generally, one would expect if oil prices are going up, stock prices are going down. So it's almost like stock prices right now are defying gravity. T-Mobile got an upgrade from one of the analysts, and I started digging into that stock a little bit. It looks like there's a fair amount of value. I'm going to pull this up on a chart for those of you who can see it. If you can't, don't worry about it. I'll sort of describe it to you. So, T-Mobile, ever since the first week in March, when the stock was at 220, has basically been on a decline. Now it's down to 192. But if you look at the financials, I mean, there's something to be said about the opportunity. I'm going to cover that next. But when I look at the chart, I'm going to come over here and draw a horizontal line at the current price. And, it should be noted that the market was up today and this was down almost 1.7%. But as I look at the current price and we go back a little bit in time, it seems to line up with another level of support. So it's kind of hit around this price a few times, and we have seen the stock move higher. So we couple that with the fact that, the company has a PE ratio of 18, relatively low, a PEG, which is the PE ratio divided by the earnings growth rate of 1.25, which is low. The company pays a dividend of 2.07% and tends to raise dividends. All of that, I think, is fairly positive, and I believe that the case can be made for this stock to go higher. And the analysts forecasted its future price, this doesn't mean it'll happen, at $260 a share. Now, I'm the same guy that told you, if you've been listening each week, about Micron technology. When it was in a similar pattern, the stock had been falling, so it had topped out at 470, fell down to 321. And I said, listen, the company has reported unbelievable earnings, and their revenue numbers, I'm going to talk to you about that, are going through the chart. As soon as the stock finds a bottom, think about being a buyer, assuming you've got the financial ability. And we've gone from 320 to 420. So I'm not right all the time like that. I will certainly remind you when I am right. I'll try to forget about the times when I'm wrong. But even though T-Mobile doesn't have the same kind of upside that Micron does, doesn't have the same kind of numbers, I still think there's a lot to get excited about. When we look at the PE ratio of Micron, it's still only at 7, and their revenue numbers moving forward are going to blow away everything that's in the current financials, at least based on the projections. So we'll come back to that here in just a little bit, that being the numbers on Micron. 10-year Treasury is trading a bit lower than last week. Last week it was 4.337. Now it's 4.307. So interest rates have come down just a touch. That's all been driven by the ceasefire, or what is supposed to be a ceasefire. I hear mixed reports on that. Oil prices are a bit elevated. They're trading right at $100 a barrel. Let me get you the latest and greatest on that. I prepared this a couple of hours ago. Yeah, now it's down to 98, still obviously elevated. A couple of months ago, we were at about 62 bucks for a barrel of oil. Now, let's call it 100. So that should have had an incredibly negative effect on stocks. It didn't help, but even though oil prices haven't come back down, markets expecting that to happen, as evidenced by the fact that it has been moving higher over the last week or so. One of the things I like to check in with every week is what is known as market breadth. So it's one thing to say, the market was up or the market was down. It's another thing to sort of look below the surface. So last week on the New York Stock Exchange, we had 1,876 stocks that were higher on the week, 875 that were lower. It was a different story on the NASDAQ. NASDAQ is tech heavy, where we had 1,875 stocks higher, almost exactly the same number as the NYSE, but 2,801 stocks were lower. When you look at the number of companies hitting 52-week highs versus 52-week lows, again on the NASDAQ, 220 stocks hitting new highs, 122 hitting new lows. It's fantastic. Almost 2 to 1 for the good guys. But on the NASDAQ, it's kind of a push. 410 new highs, 419 new lows. So, yeah, an encouraging week. But can we say that we have completely flipped the script? No, we cannot. This is last week's heat map. And number one, a whole lot more green than red. When you look at, okay, so where does the red show up? Well, most of the cybersecurity stocks were down. Plus, some of the software stocks continued to move lower, along with energy. Energy's kind of topped out. So, unfortunately, what happens is that you get a war that breaks out. Energy prices are going to be driven higher. The average person does nothing, right? All the people with money, you think they've made a ton of profits off of this? Of course they have. Probably including people in government that knew we were going to go to war with Iran. That's a whole different conversation. You want to talk about the ultimate insider trade? You work for the government, you know that you're going to go to war, it's going to drive oil prices, so you got there and start buying oil stocks. That should be criminal. Maybe one day it will be, but in any event, but the average person sits there and, all they do is bark about the fact that the cost to fill their gas tank went up when they should be going in and buying call options or at a minimum, buying stock in oil companies or in an ETF like USO. USO owns physical oil. You could participate in that move higher. But what they do, it's even worse. They wait until oil goes up, 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 then they buy it, right? And then they end up losing money. How do you lose money in oil stocks when you have a war in the Middle East? It's called timing. So that's why, the old saying goes, the rich get richer and everybody else stays the same. While the average person thinks the rich get richer because they have the money. No, it's because they have the knowledge. How do you think they got rich? You could have two people looking at exactly the same scenario, and one makes money off it and the other one doesn't because one knows how to recognize the opportunity and how to capitalize on it. That's the whole purpose of this podcast, to get you thinking the way that sophisticated investors think so you take the appropriate action. The big winners. So, what groups have done particularly well in 2026? And much of it is related to AI. But tell me if you think the average person would recognize this. Number one on the list by far is telecom fiber optics, right? So you need something to transmit this data, this AI data that's getting created. Those stocks as a group are up 134%. Then you look at computer data storage, storing the data up 102%. Let's do one more. Electric semiconductor equipment, 58.6%. There has been a ton of money made on AI without necessarily directly owning AI stocks. Again, it's where knowledge is so important. And I suspect that those things will continue to play out moving forward. So let's take a look at the PE ratios of the top um, in terms of market cap companies, right? So we've got down here at the bottom at 15 times earnings, Saudi Aramco. So that's a big oil company, right? They own tons of oil reserves. Typically, oil trades at lower PE, certainly to something like tech. But Meta is only at 18 times earnings. So you have a company like Meta trading at a PE less than Walmart by a bunch. Nvidia at 21 times. Microsoft at 21 times. I'm telling you right now, Meta and Nvidia over time, when I say over time, I don't know if it's a month or a year, 5 years, you're going to look back at their current prices and go, holy cow, they were an absolute bargain. Wouldn't hurt my feelings at all if those were in your portfolio in some capacity. Microsoft, I think, is a deal based on current prices, but it's still being sort of held back because it's in the software space along with being in the AI space. So tell me this isn't interesting. Berkshire Hathaway. So this is Warren Buffett's old company and very conservative, pretty heavy on financials, banks and insurance companies. And, they own a bunch of American Express and then consumer staples, Coca-Cola. They have a higher PE. They are considered more speculative than Nvidia. Tell me which one of those businesses are going to be worth more money in 10 years when the whole world is going through Nvidia. So this is where you got to learn how to think and how to process. Tech is looking pretty cheap. Forward PEs. So we have the S&P 500 in gold, and you have tech stocks. Tech stocks almost always trade for a multiple greater than the S&P. Not now. There's all the talk of the AI bubble. People listened, and so they started selling off their AI stocks. Some compared it to the dot-com bubble, which is just asinine. Do you know what's happening during the dot-com bubble days? You had people, and I knew some of these people, by the way. I'm embarrassed to admit. I wasn't involved with them, but they would set up these companies, just put .com in their name, go public. They had businesses that not only were they not generating profits, a lot of them didn't even generate revenue. How do you compare them to these AI companies that have revenues and profits in the billions? But some people do because average person doesn't really understand how all this works. Volatility has dropped for big tech. So even the risk associated with owning these stocks has fallen. So now the implied volatility on the Magnificent Seven stocks is lower than it is for the S&P 500. Go figure. So if you missed it, 5 years ago, there's a chance to go in and own some of these companies at discounted prices with lower volatility. Question is, you going to miss it again? Insiders are buying tech. So corporate insiders are buying XLK. This is the ETF that comprises all technology companies that make up that sector. It's at the highest level in 15 years. The people who know the companies the best are buying right now at a greater level than they have in 15 years. And there's going to be people who will miss this again, unfortunately. So, is this a good omen? So, we have discovered that every time, we have the next boom and the next tech boom, the prices just keep going higher. Cash on cash is in red. And then over here on the far right-hand side, the pink, that's forecasted returns. You've got to have a position in these companies. So it's all about power. So check this out. We're building all these AI data centers, right? And depending on how many or who you listen to, there's a ton of them going up. Well, how are you going to power them? Are you looking to those companies? So over the last year, Vertiv is up 347%. GE Vernova, 228%. Quanta, symbol PWR, 136%. They're up more than Nvidia, which is up 89%. Next, NRG Energy, 86%. CEG, which is Constellation Energy, up 54%. Vistra, they're in nuclear, 54%. So I want you to start thinking, not just with AI, but about anything where there's new developments. What are all the companies that are likely to benefit? And consider owning those as well, because they typically go up after the primaries go up. With an eye on earnings. So I want to bring you over here to 2026. These are full year estimates and their growth. Number one on the list, Micron Technology is supposed to grow their earnings this year 585%. So when their stock was down, and I told you, here's a chance, that's what it was based on. Those of you that think that Nvidia might be overpriced, Nvidia is underpriced. Their earnings this year forecasted to go up 74%. Broadcom, 65%. You want to know what stocks don't? Look at whose earnings are growing. Those are the stocks down. Amazon is poised for growth. Here's another one. So in 2024, um, Amazon had revenue of $108 billion. In 2036, granted, that's out there a ways, but their revenue is forecasted to be 600 billion. Gee, you think their stock's going to go higher? I'm going to guess yes. This one's a little tough to see for those of you that are watching on your computer, so I'm going to blow it up. Um, so the headline here is, I thought it was kind of clever, photonics, optomics, memory, oh my. So again, the companies that are benefiting from AI, this is just this year. SanDisk up 200%. Um, Lumenum up 116%. Sienna up 90%. And you could see the list goes on and on. Most of these are related, of course, um, to AI. Not all of them, but enough of them where it should definitely, have your attention. Market sentiment. We always want to check in on that. How are investors feeling? So there's a group of independent investors, and every week they ask them the question, over the next 6 months, what do you think the market's going to do? And on average, historically, 37.5% say that we think the market will go higher. 31% say it'll go lower. Well, you can see if we go back to the middle of March, only 30.4% said higher. That has been incrementally raised to 35.7%. So we're almost at averages. On the bearish side, middle of March, we were at 52% who felt that the market would go lower. Now we're down to 43%, but still significantly higher than the average. But wouldn't that make a lot of sense given what's happening in the world? I think it makes total sense. The fear greed index. So I look at this every day. Fear causes buying. Excuse me. Fear causes selling, greed causes buying, right? What makes price of a stock go up? Buying. What makes price of a stock go down? Selling. So again, taking the temperature of investors, I think is pretty critically important to forecasting where stocks are likely to go. And right now we are in the fear category, but with a huge improvement. A week ago, we were at extreme fear. So those of you that can't see this, this runs on a scale from 0 to 100, 0 being total fear. I think the lowest reading I've ever seen was 5. A year ago, it was at 8. So the fact that a week ago we were at 22 and now we're at 37, or yesterday and now we're at 40, I think 40 is an appropriate number. I think fear is appropriate. Anybody who thinks, oh, yeah, this is all clear sailing because we've had a week of the market moving higher, we would call them naive. So there's a lot of times when I look at what's happening in the market and I look at this index and feel like investors are out of touch, I think they're spot on at the moment. The future of interest rates. All right. So this has to do with what we expect the Fed to do moving forward. I guess the big question is, why do we care about what the Fed's going to do? And the answer to that is, I mentioned this earlier, the market likes low interest rates. So, we came through COVID, and in 2022, the market finished down 19%. That was the S&P. Nasdaq finished down 31%. The turning point was in October, where Fed Chairman Jerome Powell said, we're not going to raise interest rates. They were fighting inflation, but they held the line with the idea that in the future there'd be rate cuts. And ever since then, the market has gone higher. I mean, we legitimately had a Fed driven market for 3 years. We thought we would have a Fed driven market this year. When the year started, we were forecasted to have two rate cuts, one in June, one in September. Oh, that's been taken off the table. We're now not expecting our first rate cut until July of 2027. So, what is it that could cause this market to go higher? And the answer is earnings. I mean, think about it. How do you value a company? It is some multiple of its earnings. So, if corporate earnings are going up and they are expected to go up, depending on who I read, somewhere between 12 and 16% year over year, stand to reason the market ought to go up. Something like that. This could change if we get oil prices down, right? Higher oil prices are inflationary. The Fed would probably be much more accommodative. You also have a Trump appointee that, assuming that he gets confirmed, is supposed to take over in May. Fellow named Kevin Warsh, pretty impressive guy. I'm assuming one of the reasons Trump put him in, Trump's been lobbying for lower interest rates. So he probably will be, no guarantees, more dovish and easier on rates than Powell. By the way, I think Powell's done a hell of a good job. Navigated us through COVID without collapsing the economy. That was a pretty heavy skill set. And I like the fact that he has been transparent. I mean, I can listen to him deliver his statement on interest rates and the press conference, and it's not like I have to try to interpret what he's saying. He's always been very upfront. And as somebody in the financial markets, it's really all that I care about. So we're getting ready to start hearing about earnings again. So we typically start off with the financials. So this week, what are going to be some of the key announcements? We have Citibank coming out. We have BlackRock. So those should be rather telling. We have PNC Bank on Wednesday. We got Morgan Stanley on Wednesday. We have Bank of America. I mean, those are all pretty big deals. We have Taiwan Semiconductor on Thursday, along with Netflix on Thursday. I'll be paying attention to both of those. Friday, is Regions Bank going to move the market? I don't think so. Ally? No. So I think the big news will take place Tuesday, Wednesday, and Thursday. So you're going to want to follow those. They're going to give us a lot of insights, not only into how these companies are performing, but their view of the economy. So, our current heat map, let's take a look at that. And then we'll maybe do I don't know, a year to date. So I'm going to pull up FinViz. So that's where we go to find our heat map. Okay. So this is today's heat map. What do you see here? Well, it looks to me like money came out of all the scaredy cat stocks, consumer staples, and utilities. All right, this is where you go when you're afraid. The fact that they're red tells me that they were selling. And then where did that money flow? It looks like it flowed over here to technology. There you go. That would explain why NASDAQ was up more than 1%. But let's take a little broader view. If we were to go out, say, year to date, this is going to look very different. Now you see that a lot of the big tech is red. And what lights up green? Well, the storage stuff like Micron, Texas Instruments, Intel, ADI, that's analog devices. Boy, they've had really good years. Energy stocks, really good. Industrials and materials, um, really good. That's all AI data centers. And consumer staples has done pretty well. So that's a little longer view. There's our heat map. How about sector performance? Let's take a look at that. So this is year to date. See how the various sectors have done. First thing I want to point out, the S&P 500 is now positive on the year. Yes. So the S&P is an index consisting of 500 large cap stocks. Doesn't it feel like the market's down for the year? It's not. And of the 11 sectors that make up the S&P 500, 1, 2, 3, 4, 5, 6, 7 of the 11 are higher. Only 4 are lower. The biggest winner, energy, up 27.54%, followed by materials at 14.7%, and industrials, 11.41%. And those were very predictable. On the downside, you've got financials. And by the way, I think financials are kind of a sleeper sector right now. I think there's a lot of value there. Financials should be helped because of deregulation. Private credit has been an issue. I don't know if you follow that story or not. And there are some economic fears. If we get oil prices down, those will go away. You want to talk about a place to park money? I think financials has got some upside. And the fact is that technology is still down a little bit on the year. And, we've extolled the virtues of that sector today and in previous weeks. This week's key announcements. All right, so what's kind of making news? So this is courtesy of MarketWatch. So last week's um, major announcements. What is it that was really important? Thursday. Man, there was a lot that came out, and frankly, it was all negative. Personal income, month over month, was down 1%. Now, this is delayed. This is February's numbers, because we still have a partial government shutdown because they can't figure that out as well. Personal spending was up. So go figure that. Income's down 0.1%. Spending is up 0.5%. That looks like a good combination. By the way, if you don't know sarcasm, that was sarcasm. Inflation numbers. Again, these were delayed thanks to the partial government shutdown. But the inflation metrics that the Fed prefers is PCE, it's personal consumption expenditure, and their targeted rate for inflation. is 2%. Well, core PCE, so core is minus energy and minus food, was at 3%. That was kind of what was expected. It was down 1/10 from the previous month. So I guess that was good. But again, this is February. We'll see what March looks like. Initial jobless claims were forecast coming at 210,000, came in at 219,000. Unemployment above estimates. And wholesale inventories up 0.8%, which means some of these companies weren't able to sell goods at the rate they thought they would. And then we move into Friday, where this is CPI, Consumer Price Index, for March. So it's more current. And it went up 0.9%. Now, fortunately, the core didn't go up as much. So when you take out energy prices, it wasn't nearly as bad. But last week's news, I'll just be straight up with you, was not great. All right, let's take a look at the charts. Anytime you want to know what's going on, always look at the charts. And I'm going to share with you another closed trade that we did that turned out really nice. We do these trade ideas of the week that I'll tell you about. In fact, I'll give you the website for it if you're interested in checking it out. I want to look at the S&P 500. So let's just put in the SPX. So I have these two lines drawn. If you're with me last week, I was talking about how we were in a pretty narrow trading range on the S&P 500 between 6,800 and 7,000. And then we broke well below the 6,800. So I looked for support down here at about 6,550. We didn't get it. We fell all the way down to 6,350. And then we started clawing our way back. So I told you, well, the first thing we got to do is get above 6,550. And we did that. And I said, okay, before you start celebrating, we got to get back above 6,800. And we have done that. We're now sitting at 68.86. So, where did we start the year? Let's take a look. We started the year January 2nd at 68.58. So we are right back where we began. So for us to take that next leg higher, and I called it at the beginning of the year, I said, I thought we would see double-digit returns for this year. I didn't know we'd have a war. And we were headed in that direction. And then, war broke out, and that'll put a hitch in your get along. I still think we're going to have double-digit returns if we can get past this war in the next week or two. But that's very encouraging. We're up above our 50-day moving average. The MACD is really strong. RSI has been moving up. On balance, volume moving higher. As of right now, everything looks great, but keep something in mind. We are in a news-driven market. So at any time, one announcement, and this changes. Looking in on the VIX. So the VIX is a volatility index of the S&P 500. And they call it a fear index. So typically the VIX will trade between 13. When we're down to 13, it means the markets are completely calm. Investors aren't even thinking about risk at that point. So that's a bottom blue line. The upper blue line is at 25. You get above 25, there's some stuff going down. And by the way, very recently, as you might imagine, there's been some stuff going down. We got all the way up to 31. The good news is that things have started to settle. We're back down to around 19. 19 is almost in the middle of the range. And all of that happened in a matter of about a week. Pretty crazy. We have very short memories in this country, and sometimes that can serve you very well. So, happy to have a lot of good stuff to report this week. Let me show you one of our closed trades. So, my trading partner, Pam Rios, and I um, put out trade ideas to subscribers on a weekly basis, where we'll have anywhere from, depending on the week, typically 2 to 4 different ideas. Sometimes it could be less than that. Sometimes it could be nothing if we don't feel like there's anything that really looks good to us. And these are predominantly option trades, should only be considered by people that understand options. But I like to show you trades that we have closed. And why trades that we have closed? Because now we know what the result was. So this was a trade on AbbVie. And we did a spread trade on this. Hang on a second. So this is where we basically make a bet as to where the price of a stock is not likely to go. Hang on, there's something on that that looks a little bit wonky. Okay, found it. So on this particular trade, hey, don't get away from me yet, you. Let me change this for you. This should say 207. There we go. Knew something looked weird. And I'll pull up the chart on this here in a second. But what we did was we made a bet that the price of AbbVie, big pharma company, would not, at the expiration, which was going to be April the 10th, would not be below $207.50 per share. Let me show you what actually happened on that. Let's pull up AbbVie and tell you why we believed that. So you can see there is our level of um, our level of support. And then we got a really nice move to the upside. And the long and the short of it is, what was the final number on this trade? We made a profit of 23% in 9 days. What do you think? How long does it take the average investor to make 23% on their money? 2 years. We just did it in 9 days. So those of you that have some background in trading options and you want to check out this service, you would simply go to your browser and type in trade ideas of the week, and it will take you to this website. There we go. And what I want you to do, see the video in the upper right here. If I were to click on it, Steven Sitkowski here with my partner, Pam Rios. And so Pam describes kind of the process that she goes through for identifying potential trades. And it has been just a fantastic service that people have really enjoyed. So, at a minimum, watch the video, see if it's something that might make sense for you. Well, what an awesome time. Once again, I so appreciate you tuning in, listening. I hope you're getting value out of this. I'm creating, some things for you to think about, and more importantly, maybe for you to act on for the benefit of you and your future. So I'll be back with you again next week. Until then, be safe, be blessed, Bye for now.